In this video, we're going to walk through the journal entries related to the payment of cash dividends and closing out the related temporary accounts at year end. We're told that the Jones Corporation has 200,000 shares of stock authorized, 130,000 shares issued, and 90,000 shares outstanding. That means it has reacquired 40,000 shares and is holding them in the Treasury. With respect to our dividend transactions, we've got 3 dates we need to be concerned with. The first is the declaration date, the date the corporation declares a dividend. The next date is the date of record. Whoever owns the stock on the date of record is entitled to receive the dividend. And then finally, there's a payment date, the date at which the dividend is actually paid. So we're told that on August 1st, the date of record, or the declaration date, the Jones Board of Directors declares a cash dividend of $1 per share with a record date of September 1st. The dividend is going to be paid on October 1st. So again, our declaration date, August 1st. The date of record, whoever owns the shares as of September 1st will be entitled to receive a $1 per share dividend. And the dividend will be actually paid on October 1st. So our journal entries on the declaration date, we're going to have a liability of $90,000. That's the 90,000 shares that are outstanding times $1 per share. And of course, we will then decrease equity by having a debit to dividends. So our journal entry will be a credit to the liability, dividends payable, $90,000. And again, that's the 90,000 shares outstanding times $1 per share. We've got 130 shares issued, but we've reacquired 40,000 and are holding those in the Treasury. Dividends aren't paid to Treasury shares. So we credited the liability for debited dividends for 90,000, and we credit dividends payable for 90,000. And we've got our T accounts off to the right. So after our August 1st entries, dividends will have a $90,000 balance, and dividends payable will have a $90,000 credit balance. Now again, on the date of record, no entry is made. So there's no entry that's going to be made on September 1st. We're just going to tabulate the names of all of our shareholders as of that date. Because if you own the shares on August 31st, you don't get a dividend. But if you do own the shares on September 1st, you're entitled to a dividend. If you sell your shares on September 2nd, it doesn't matter. If you own them on September 1st, you're entitled to the dividend. Now, when we pay these dividends on October 1st, we're of course going to have a decrease in cash of $90,000. And we will decrease our liability by $90,000. We can see our T accounts left over from our August 1st transaction. And when we debit dividends payable, we will post that to the T account. And we will, of course, will have credited cash for $90,000. So as of October 1st, we've zeroed out the dividends payable account, but we still have a $90,000 debit balance in that temporary account called dividends. Let's go ahead and prepare our closing entry at year end. So at year end, we have that $90,000 debit balance in dividends. And again, at year end, we need to close that out. Dividends is a temporary account. So if you've got a $90,000 debit balance in dividends, we need to zero it out. So we're going to need to credit dividends for $90,000. So we will credit dividends for $90,000. Of course, we need to debit something else. And that something else will be a debit to retained earnings. And that makes sense because as we pay dividends, we reduce stockholders' equity. We are paying out earnings. Notice at the time we close out dividends, though, there's no impact on our accounting equation. The entry to dividends, the debit to dividends decreases equity, but the credit to retained earnings increases equity. And so we've zeroed out our dividends account at year end by closing it to retained earnings. just like we close out expenses to retained earnings and we close out revenues to retained earnings.